While most investors focus on a company's P ratio, its earnings growth, return on equity, etc., very few pay enough attention to the quality of people running that business. Now, maybe this was possible in the past, but with the world of business becoming more competitive, more global, and more technology oriented, it is becoming increasingly obvious that the presence of a sound management team is what will differentiate a good business from a great one. In fact, no one knows this better than Warren Buffett, who has often said, and I quote, "Over time, the skill with which a company's managers allocate capital has an enormous impact on the value of an enterprise." Charlie and I look for companies that have able and trustworthy managements. So you need two things: a moat around the castle, and you need a knight who is continuously trying to widen that moat. So the big question facing us is, how do we identify companies with managers who do a remarkable job of delivering value to their shareholders consistently? And so in this video, we shall see how investors can better evaluate the quality of management and consequently improve their investing decisions. This video turned out to be a bit longer than expected, but we thoroughly enjoyed putting this together, and especially for a topic that is not discussed enough among investing circles. With that being said, let's begin. Assessing the quality of a company's management is not easy. It's a highly intangible component and is mostly subjective, which means different investors would evaluate it based on their own criteria and experience. In our opinion, there is a hardware and a software side to measuring management quality. The hardware side includes the manager's qualifications, education, experience, product mix, capital allocation, compensation, etc. And then there is also the software side, which includes areas like governance, culture, how they treat employees, risk-taking, customer focus, etc. As examples, think of companies like Costco in the US and the Tata Group in India, which are well known for their ability to enhance shareholder value and yet do that in a respectable manner. Now, all this can be a little here and there, so to organize it a bit, I shall be evaluating management quality using the 4C framework. The 4C framework is nothing but 4 essential characteristics by which we evaluate managements. The first C stands for capable or capability. The second C is commitment. The third C is candidness. And the fourth C in our framework is compassion. Each of these 4 pillars have some key points within them, which we shall study in greater details in the coming sections, starting with the first C, which is capability. We all want our capital, our money, to be handled by a very capable business leader and management team so that it can grow and compound over time. Now, capability can be looked at and measured in multiple ways. For instance, the CEO, CFO, COO, the board members are very important positions in an organization, and therefore investors should individually check them out, which includes things like how long have they been with the company, years of experience, any notable successes they've had in past assignments, their qualifications, etc. This is especially important in smaller companies where we see the founder's young and inexperienced son or daughter being installed as the COO or the marketing head once he or she finishes their MBA from an international B school. In fact, I've always found the analyst meetings that the top management has every quarter to be an excellent way of judging the management's thought process and competence as they answer some rather difficult questions which are posed by these analysts. A second part to evaluating capability is via an understanding of the company's strategic direction. Now, annual reports have a section titled Management Discussion and Analysis, or MD&A for short, which is an important section for any serious investor to read. The MD&A discusses the company's performance, its current financial standing, and most importantly, the management's view of the future, the rising trends, and the company goals. So this MD&A is available in every year's annual report, and over the years, if one finds that the company is changing directions too often or revising estimates or dropping projects, then that's a red flag, and I would think twice before allowing that management to use my capital. And just like the MD&A, one can use company announcements, press releases, investor presentations, and of course the quarterly earnings calls to have a better understanding of the company's direction and proficiency. The third capability marker relates to efficient capital allocation, which in my opinion is the most important function of any management team. So what is capital allocation? Well, simply put, it refers to all investment decisions made by the company, which includes the projects it wants to pursue, what to acquire, what to divest, stock buybacks, priorities, etc. These decisions are along the idea that for every 1 rupee of capital that is allocated, the management should be able to win back more than a rupee over a period of time. The more the management can extract from that rupee, the more capable or efficient it is. On a statistical basis, this efficiency can be measured using the return on capital employed metric, which explains how well the company's capital, that is, the equity and the debt, is being utilized. Now, the ROCE can be calculated in a few different ways, but the one I prefer is where the company's earnings before interest and taxes are divided by the company's long-term liabilities and shareholders' equity. So essentially, the numerator denotes the returns earned while the denominator shows the capital used up to generate those returns. This explains the management's efficiency, and needless to say, a high ROCE means a highly efficient and capable company. And while the benchmarks change significantly from sector to sector, from an Indian perspective, a bulk of high ROCE companies within the large cap space emerge from the FMCG and the IT sector. The final area in our study of management capability is debt management. While debt is a simpler way for managers to bring in growth capital, the problem with debt is that it needs to be paid back and with interest. And if the debt in the company's books becomes unmanageable, then it can lead to a sharp decrease in stock price and even bankruptcy, which is what we saw with Bhushan Steel, Reliance Communications, Videocon, etc. Now, when it comes to measuring this, the most commonly used metric is the debt to equity ratio. But personally, I prefer instead the interest coverage ratio, which explains how many multiples of interest a company can manage with its pre-tax profits. As one might expect, a high interest coverage ratio is always better. But to highlight the metric's importance, here's a list of some large cap companies with an interest coverage ratio of less than 4. Notice here that other than the Adani siblings, a bulk of the companies are into utilities, power, ports, cement, and other industrial projects. So to put this section together, other than knowing the management and its future direction, the ROCE and the interest coverage ratio are two metrics that I would keep an eye on. And if you want to extend that list, then you can also explore and compare a company's operating margin, the current ratio, and its return on equity for a better understanding of the company's capabilities. There is little doubt that we all seek a management team and a business leader who is committed to creating long-term value for its shareholders. Now, a phrase like creating long-term shareholder value might seem like a buzzword, but if we distill it down, there are a few areas that can give us a better picture of how committed the management is. The first area of note is management compensation, which is the sum total of salaries, bonuses, stock options, and other benefits that are given to the team. Now, the top management in most companies typically pulls in compensation running into a crore or more, and understandably, it is difficult to judge how much is too high. But if the management is taking a very high salary while the company is struggling, then that surely doesn't speak too highly of the management's commitment level. In this context, a recent event happened at Sun TV Network where a majority of institutional shareholders voted against the reappointment of the directors. Their objection was not against their position in the company, but it was on their staggering remuneration of 87.5 crores each, which totaled to 57% of Sun TV's total wage bill and over 10% of the company's net profits. So as an investor, it is our job to observe such excesses and, more importantly, understand if the management is more interested in lining up their own pockets at the expense of the shareholders. A second indicator of commitment, and a rather popular one, is insider buying. So logically, if the promoter, CEO, or a key member of the management team buys shares in the company, then it is usually construed as a great and positive indicator of the stock's potential. However, to really evaluate this better, it is important to know how long the management is holding on to these shares. What I mean is, if one notices that the managers have a history of purchasing shares and then flipping them for a profit within a few months, then this is definitely not a good sign. The good news is that there are quite a few tools to track management buy-ins and sellouts, but the one I generally use is trendline.com, which pulls up the data from disclosures made by companies under SEBI's prohibition of insider trading and SEBI's substantial acquisition of shares and takeovers regulations. A third area one needs to look out for are the related party transactions. You see, the requirement of disclosing related party transactions emanated from the commonly used and unethical practice of Indian promoters of redirecting company capital and resources to other companies which are mostly unlisted. As one can imagine, these transactions were done to benefit the promoters and more often than not were at the expense of shareholders. This included situations like giving interest-free loans to another company, selling company assets at dirt cheap prices to the promoters, or buying assets at high valuations, etc. On this last point, Aurobindo Pharma was in the news last year for wanting to acquire a drug company for 420 crore rupees. This announcement triggered an intense sell-off in company shares, with the price falling by over 20% as analysts questioned the intentions of the promoters, given the general perception that the promoters of the acquiring and the target companies had a very close relationship. And a fourth and final proof of management commitment is the level of skin that they have in the game. That is, how aligned are the management's goals with that of the shareholders. So if the management is only paid a salary and nothing more, the motivation might lack to improve the business and enhance the shareholder value beyond the call of duty. But if the management team also held significant shares in the company, then their intentions will be more in line with the investors. For example, most Adani Group companies have a high promoter holding, which means the fortunes of their shareholders is aligned to that of Gautam Adani. In fact, the slightest news of a CEO offloading shares can bring about a massive sell-off like what we saw last month when the shares of PB Fintech crashed by more than 13% exactly a day after its CEO Yashish Dahiya sold some 37 lakh equity shares. Incidentally, this happened in spite of many news outlets reporting that Mr. Dahiya's shareholding in PB Fintech has actually increased over time and is likely to increase further as more of his stock options get exercised. So to put it together, aligning the management team's wealth with the shareholders is a great way to extract commitment, as the goals are now non-conflicting and similar. A candid business leader is someone who is transparent with what is going wrong with the business, as he or she is about the success stories. Being candid goes into the root of integrity, which also shows that the management team is not only principled, but also has strong morals and the courage to report when a mistake has happened. For example, I joined NIT Limited right out of B School in 2002, which, believe me, was a horrible time to be in the IT education business. But in spite of the tech bubble and everything that was happening around with the stock price, it was really pleasant and surprising to see the company chairman, Rajinder Singh Pawar, and the co-founders never shying away from communicating the goods and bads in analyst calls, shareholder meetings, and even to 22-year-old freshers like me. That's the kind of management team we want as investors, someone who is not going to hide problems, but will tell it upfront together with the possible damage and the potential solutions that can mitigate or overcome these problems. Now, to see how truthful the promoters or management team is likely to be, one needs to know if any of the executives have done anything fraudulent, illegal, or questionable in the past, which can be accomplished with a simple background check on Google. Next, one needs to understand if their word counts for something, which means the investors need to pick up a few annual reports and make a list of what all was said, which can then be compared with what was actually achieved by the management team. This way, you will get to know if those managers are just talkers or if they can actually walk the talk. Finally, there is the compassionate side of management, and while this might come across as strange and surprising, there have been enough studies that show that companies and managers who care for their employees, environment, culture, and the softer side of leadership also turn out to be winners in shareholder value creation. For example, Glassdoor does this annual survey on the best places to work. And it is no surprise that the top companies in the 2022 version, which included Nvidia, HubSpot, Box.com, Google, etc., have also been amongst the top performing stocks in the last 5 years. So there's definitely some causality here between having happy, contented at work employees and the stock performance of a company. This connection is now becoming more and more important in the digital age, where a company's most important assets are its people. To put it differently, a compassionate management is like building a digital moat around one's business, which not only attracts the best talents in the industry, but also retains these happy to work employees. Truth be told, having a good management does not get enough credit in our valuation models. But now we know that evaluating management quality is an integral part of an investment thesis, and only relying on the financial results will never give a complete picture. I sincerely hope this video has changed some perceptions and given you a framework for better assessment of management quality. In fact, our 4C framework can also be presented as a 10-question checklist, which you can incorporate as part of your stock analysis to identify potential compounders. The questions here cover areas relating to acquisitions, widening of the economic moat, long-term versus short-term gains, ownership structure, communication, mistakes made, debt management, etc., all of which were discussed as part of our 4C framework. And with this, we come to the end of this video. We've added some of the resources we used in the creation of this video in the description. And if you like this presentation, then do tap on to that like button to subscribe to our channel and also share this video with your friends. Thank you for your time, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.